Comprehensive analysis of PAR technology. PAR. Through Warren Buffett's investment lens, one business quality and economic moat analysis, PAR Technology Corporation, NYSE. PAR operates as a specialized technology provider in the food service and hospitality industry, offering a comprehensive suite of software, hardware, and services to restaurants and retail establishments globally. Founded in 1968, the company has evolved from its initial focus on government systems to become a leading player in restaurant technology, serving major quick service, fast casual, and table service restaurants worldwide. The company's solutions are deployed in over 140,000 locations across 110 countries, creating a substantial footprint in the industry. 1.1 Revenue model and business operations. PAR generates revenue through a diversified business model that includes subscription services, 64% of total revenue, recurring revenue from cloud-based software solutions, including point-of-sale PAR, PAS, digital ordering, PAR ordering TM, customer loyalty punch, and back-office operations, PAR OPSTM. Hardware sales, 24% of revenue, point-of-sale systems and related equipment. Professional services, 12% of revenue, implementation, maintenance, and support services. The company's subscription-based revenue model provides predictable recurring income, with annual recurring revenue reaching $287 million in Q2 2025, representing 49% year-over-year growth. This high-growth recurring revenue stream is particularly valuable as it creates stability and predictability in the company's financial performance. 1.2 Competitive advantages and economic moat. Integrated ecosystem. PAR's Better Together strategy offers an integrated platform approach that combines point-of-sale, digital ordering, loyalty, back-office operations, and payment processing into a unified system. This creates significant switching costs for customers who become embedded in PAR's ecosystem, as moving to a competitor would require replacing multiple integrated systems simultaneously. Market specialization. With 40 years of industry focus, PAR has developed deep domain expertise in the specific needs of restaurant operations. This specialization creates barriers to entry for generalist technology companies that lack PAR's nuanced understanding of restaurant workflows, inventory management, and customer engagement patterns. Scalable platform. PAR's cloud-based architecture allows it to efficiently serve businesses of various sizes, from independent restaurants to global chains like Burger King and Popeye's Louisiana Kitchen. The company's global reach 110 countries. This provides distribution advantages that smaller competitors cannot match. Data network effects. As more restaurants use PAR's platform, the company accumulates valuable data on consumer behavior, operational patterns, and industry trends that can be leveraged to improve products and provide valuable insights to customers. This creates a self-reinforcing advantage where more data leads to better products, which in turn attracts more customers. Strategic acquisitions. PAR has strategically expanded its capabilities through acquisitions, including Stuso 2024 for convenience store technology and Task Group 2024 for international unified commerce solutions. These acquisitions have enhanced PAR's product breadth and geographic reach. Table PAR. Technology's economic moat. Assessment using Buffett's framework. Moat component PAR. Technology status assessment. Brand value. Established 40-year reputation in restaurant technology. Moderate switching costs. Integrated ecosystem creates high migration barriers. Strong network effects. Data accumulation from widespread platform. Usage. Developing cost advantage. Scalable platform with growing subscription revenue. Moderate specialization. Deep restaurant industry expertise. Strong despite these advantages. PAR operates in a competitive landscape that includes traditional POS providers, emerging fintech companies, and potential competition from large technology firms entering the restaurant space. The durability of PAR's economic moat will depend on its ability to maintain technological innovation and customer satisfaction while expanding its service offerings. To management quality assessment, Warren Buffett places immense importance on the quality and integrity of management when evaluating investment opportunities. PAR's leadership team demonstrates several characteristics that align with Buffett's preferences for capable and trustworthy stewards of capital. Leadership, expertise, and vision. CEO Savneet. Singh has articulated a clear strategic vision focused on creating an integrated technology platform for the restaurant industry. Under his leadership, the company has shifted toward a subscription-based model that generates more predictable recurring revenue. Singh emphasizes the company's commitment to AI integration, stating PAR is all in on AI during the Q2 2025 earnings call. Capital allocation strategy. Management has demonstrated a strategic approach to growth through both organic investment and acquisitions. The acquisitions of Stuzo 2024 and Task Group 2024 expanded POR's capabilities into convenience stores and international markets. Divestiture of the government segment in 2024 allowed the company to focus resources on its core restaurant technology business, investment and product development, particularly in AI-driven solutions like Coach AI, shows focus on innovation. Shareholder alignment, insider ownership is relatively low at approximately 1.04%, which may raise concerns about alignment with shareholder interests. Transparency and communication. Management provides regular updates on key performance indicators, including annual recurring revenue, ARR, active sites, and subscription revenue growth. The company acknowledges challenges openly, such as slower POS rollouts and impacts from macroeconomic factors. Operational execution. Management has demonstrated ability to grow revenue significantly, 44% year-over-year in Q2 2025, while improving operational efficiency. The company's focus on multi-product deals, 70% of new engagements include multiple products, shows strategic execution of the Better Together strategy. However, some aspects might give Buffett pause. The company's relatively high debt levels, $400.31 million, and negative cash flow from operations, $11.62 million TTM, suggests potential concerns about financial discipline. Additionally, the company's continued GAAP profitability challenges, net loss of $86.28 million TTM. Despite revenue growth may indicate difficulties in achieving sustainable operating leverage. 3. Financial strength evaluation. Warren Buffett prioritizes companies with strong financial fundamentals, including consistent revenue growth, healthy profit margins, high returns on equity, minimal debt, and strong free cash flow generation. PAR's financial profile presents a mixed picture when evaluated through these lenses. 3.1 Revenue growth and profitability. PAR has demonstrated exceptional revenue growth in recent periods. Revenue TTM, $418.02 million quarterly revenue growth YoY, 43.80% subscription services. Revenue growth, 60% year-over-year in Q2 2025, however. Profitability remains a significant concern from a traditional buffet perspective. Net income TTM, $86.28 million. Gross margin TTM, 44.82%. Operating margin TTM, minus 15.59%. Profit margin TTM, minus 20.64%. The company's subscription services gross margin is more encouraging at 66.4% non-GAAP, indicating strong potential profitability once the company achieves sufficient scale. 3.2 Return on equity and invested capital. Buffett places great emphasis on return on equity ROE and return on invested capital ROIC as measures of management's ability to generate value from shareholder capital. PAR's performance on these metrics is currently poor. Return on equity TTM, minus 12.65%. Return on assets TTM, minus 3.33%. Return on invested capital TTM, minus 3.65%. These figures fall dramatically below Buffett's typical threshold of 15% plus for attractive businesses. The negative returns reflect the company's current loss-making status as it invests heavily in growth and market development. 3.3 Debt levels and financial health from a balance sheet perspective. PAR shows some concerning metrics. Total debt, $400.31 million. Cash and equivalents, $85.69 million. Net cash position, $314.62 million. Debt-to-equity ratio, 46.59%. Current ratio, 1.70. The company's negative net cash position and relatively high debt levels would likely concern Buffett, who prefers companies with strong balance sheets that can weather economic downturns without excessive leverage. 3.4 Free cash flow generation. PAR's cash flow generation remains weak, Operating cash flow TTM, $11.62 million. Capital expenditures TTM, $1.76 million. Free cash flow TTM, $13.38 million. The negative free cash flow contradicts Buffett's preference for businesses that generate abundant cash that can be reinvested or returned to shareholders. Asterisk table. PAR. Technology. Financial health. Assessment 202 for 2025. Asterisk financial metric status. Buffett standard assessment. Revenue growth 43.8%. YoY, consistent growth, excellent profit. Margins minus 20.64% net. Consistently profitable poor ROE TTM minus 12.65%, 15% plus very poor ROIC TTM, minus 3.65%, 15% plus very poor debt. Equity 46.59%, minimal debt concerning. Free cash flow $13.38 million strong and consistent poor. For intrinsic value estimation, Warren Buffett focuses on intrinsic value, the discounted value of the cash that can be taken out of a business during its remaining life rather than prevailing market prices. Estimating PAR's intrinsic value presents challenges due to its negative earnings and cash flows. But we can utilize several approaches to gauge whether the business might be trading at a discount to its intrinsic value. 4.1 Discounted cash flow analysis. Applying a traditional DCF valuation to PAR is challenging due to the company's negative earnings and cash flows. However, we can examine various market-based valuation metrics. Market capitalization, $1.79 billion. Enterprise value, $2.10 billion. Price, sales ratio, 3.99. Price book ratio, 2.08. Enterprise value revenue, 5.03. These valuation metrics appear rich relative to current financial performance, particularly given the company's lack of profitability. The high price-sales ratio suggests investors are pricing in significant future growth and profitability improvements. 4.2 Growth-based valuation. Considering PAR's exceptional growth metrics, annual recurring revenue growth, 49%. Year-over-year subscription revenue growth, 60%. Year-over-year market position, leading provider in a growing restaurant technology market. The company's growth rate arguably justifies premium valuation multiples compared to slower-growing traditional technology companies. However, the valuation remains highly dependent on the company's ability to eventually achieve profitability and positive cash flows. 4.3 Analyst price targets. Analyst expectations provide additional perspective. Average price target, $78.43. Current price, $44.02. Upside potential, 78.17% based on these figures. These targets suggest analysts believe the company's growth trajectory will eventually lead to improved financial performance and valuation expansion. 4.4 Valuation challenges and considerations. Valuing PAR requires making assumptions about path to profitability. When will the company achieve consistent GAAP profitability? Growth sustainability. Can the company maintain high revenue growth rates? Market potential. $164 billion specialty insurance market growing at 10.7%. CAGR economic sensitivity. Potential cyclicality in restaurant spending during economic downturns based on the available data. PAR appears fully valued based on current financial performance, but potentially reasonably valued based on long-term growth prospects if executed successfully. This uncertainty would likely make Buffett cautious, as he prefers businesses with more predictable cash flows that can be valued with greater confidence. 5 Long-term prospects and risks. Evaluating PAR's long-term potential requires examining industry dynamics, competitive positioning, and various risk factors that could impact the company's ability to compound capital over the next decade. 5.1 Industry outlook and growth potential. The restaurant technology market represents a substantial opportunity. Digital transformation. Restaurants are increasingly adopting technology to improve operations, customer experience, and efficiency. Cloud-based solutions. Shift from legacy on-premise systems to cloud-based platforms creates migration opportunities. Data analytics. Growing demand for data-driven insights to optimize restaurant operations and marketing. PAR is well positioned to benefit from these trends through its comprehensive platform that addresses multiple restaurant technology needs. 5.2 Competitive threats and market position. PAR faces competition from several fronts. Traditional POS providers, established competitors in the point-of-sale market, emerging fintech companies, digital native competitors with specialized solutions, large technology companies, potential future competition from tech giants entering restaurant technology. PAR's competitive position appears strong due to its integrated platform approach, industry specialization, and growing customer base. The company's expansion to 140,000 locations across 110 countries creates significant barriers to entry. 5.3 Key risks and challenges. Several risks could impact PAR's ability to compound capital over the long term. Profitability challenges. Continued losses could strain financial resources. Execution risk. Integration of acquisitions and product development must be successful. Economic sensitivity. Restaurant spending may decline during economic downturns. Technological disruption. Emerging technologies could disrupt PAR's current offerings. Debt burden. High debt levels could limit financial flexibility. 5.4 Capital compounding potential for PAR to compound capital effectively over the next decade. Several conditions must be met. The company must achieve profitability and maintain high returns on invested capital. Subscription growth must continue as customers adopt more products. International expansion must be successful without diluting returns. Management must maintain disciplined capital allocation as the company matures if these conditions are met. PAR has the potential to become a much larger business over the next 5 to 10 years. However, the uncertainty around these factors makes the company's long-term prospects less predictable than established businesses. Buffett typically prefers. 6. Final verdict. Buffett-style investment suitability. Based on comprehensive analysis through Warren Buffett's investment principles, here's how PAR Technology measures up against each of the key criteria. A. Understandable business. PAR provides technology solutions to restaurants, which is a reasonably understandable business model. However, the complexity of integrated software platforms adds some opacity. Rating: moderately understandable. B. Consistent earnings. PAR has not achieved consistent earnings or free cash flow generation. The company continues to report substantial net losses despite revenue growth. Rating: unsatisfactory. See good row. ROIC: PAR's return on equity, 12.65%. Return on invested capital, 3.65%. Fall dramatically below Buffett's typical threshold of 15% plus. Rating: very poor. D. Low debt. PAR's debt-to-equity ratio of 46.59% and negative net cash position are concerning from a Buffett perspective. Rating: unsatisfactory. E. Attractive valuation. Traditional metrics suggest full valuation, though growth prospects may justify premium multiples. The negative earnings make valuation challenging. Rating: mixed. F. Long-term moat. PAR demonstrates several competitive advantages, including switching costs, industry specialization, and an integrated platform. However, the durability of this moat is unproven. Rating: developing. 6.1 Overall assessment. PAR Technology does not meet most of Warren Buffett's investment criteria at its current stage of development. While the business operates in a growing market and has demonstrated impressive revenue growth, the lack of consistent profitability, negative returns on capital, and debt concerns make it unsuitable for a traditional Buffett-style investment approach. The company might be better suited for investors with a growth-oriented perspective who are comfortable with higher risk in exchange for potential future market leadership. Buffett would likely prefer to observe PAR for several more years until it demonstrates a clear path to consistent profitability and strong returns on capital before considering an investment. For those interested in the technology sector through a Buffett lens, potentially more suitable candidates might include companies with longer track records of profitability, stronger economic moats, and consistent returns on capital, though these would need to be evaluated based on their own merits. Against us best criteria, table, PAR Technology, Buffett-style investment suitability summary. Criterion: assessment, explanation, understandable business, moderate restaurant technology model, understandable but complex consistent earnings, poor not yet profitable. Substantial ongoing losses, good row. ROIC, very poor row, minus 12.65%. ROIC, minus 3.65% negative. Low debt, poor debt to equity, 46.59%. Negative net cash, attractive valuation, mixed, difficult to value due to lack of profitability. Long-term moat, developing competitive advantages, but durability unproven. Overall suitability not recommended, fails too many key criteria for Buffett-style investment.